The world of ETFs, it just keeps getting wilder. We're way past the days of just simple funds that hold, hundreds of different stocks. Today, we're diving into something completely different. An ETF that promises a weekly payout, but from just one single stock. Yep, it's the Roundhill HOOW WeeklyPay ETF, ticker HOOW, and we're going to break down exactly how this thing ticks.
So there's the big hook right there. Weekly income from a single stock. In this case, Robinhood. I mean, how does that even work? Is it like a dividend? Is it something else entirely? To really get to the bottom of this, we're going to go straight to the source, the fund's own documents. Let's pull back the curtain and see what's really happening under the hood. Okay, so right off the bat, we need to be clear, this is not your typical ETF at all. We are not talking about some big diversified basket of companies. Nope. This is a highly specialized tool, and it works in a completely different way than just, buying and holding a stock. All right, let's get the basic stats out of the way. The ticker is HOOW. The underlying stock, just one, Robinhood. And take a look at that expense ratio, 0.99%. That's definitely up there. Okay, so those are the basics. Now let's dig into the strategy, because that's where this thing really gets interesting. So this fund is basically trying to juggle two things at the same time. First, it wants to give you leveraged returns on Robinhood stock every single week. And second, it's designed to send you a weekly cash payout. So it's kind of trying to be a growth and an income play, all wrapped into one. But as you're about to see, there are some pretty major twists here. Okay, so the big question is, how? How in the world does it actually pull this off, generating leveraged returns and a weekly payout? All right, let's get into the engine room and really look at the mechanics. The first number you absolutely need to understand is 120%. See, the fund targets 1.2 times the weekly return of Robinhood stock. And this next part is critical. It resets every single week. So let's say Hood stock goes up 10% in a week. The fund is aiming for a 12% gain. But, and this is a big but, that sword cuts both ways. If Hood drops 10%, this fund is designed to drop 12%. It's magnified exposure for better and for worse. So, you might be asking, how does it get that 120% exposure? Well, it's not by doing something simple like borrowing money to buy more stock. Nope. Instead, it uses these pretty complex contracts called total return swaps. The easiest way to think about it is like this. It's a deal with a big bank. The bank agrees to pay the fund the exact total return of Robinhood's stock. In exchange, the fund pays the bank a fee. It's a clever way to get the performance of the stock without ever actually owning a single share. And look, the fund's own legal document, the prospectus, could not be more clear about this. I mean, they state it flat out. When you buy HOOW, you are not buying Robinhood stock. Let me say that again. You're not buying the stock. You're buying into a fund that uses derivatives, those swap contracts we just mentioned, to basically copy and amplify Robinhood's weekly moves. That is a hugely important distinction to understand. All right, let's talk about the other side of the coin, that weekly payout. This is probably the feature that gets the most attention, right? But it's really important to know it is not a dividend. Not in the traditional sense, where a company's sharing its profits with you. This is something else entirely. First things first, this payout isn't some fixed amount you can count on. It changes every week. See, the fund uses a specific formula. It looks at the stock's recent performance and this thing called implied volatility. Now, that sounds complicated, but all it really means is how much traders think the stock is going to swing around, up or down. So a nice, calm, stable week, that's probably going to result in a very different payout than a crazy, wild, unpredictable one. So this is the really crucial part. Where is this money actually coming from? Well, the fund's own documents say that a big chunk of these weekly payments are expected to be what's called a return of capital. Now, this is not profit. This is the fund literally handing you back a piece of the money you already invested. It's your own money coming back to you. Now, for taxes, this lowers your cost basis. What does that mean? Well, you might not pay taxes on that cash right away, but it could lead to a much bigger capital gains tax bill down the road when you decide to sell. Okay, so we've talked about the potential upside. But with a product this complicated, you've got to believe the risks are just as important, if not more so. And the fund's own legal filings, well, they spell them out in a lot of detail. So let's dive into that. And get this, the prospectus itself uses this exact phrase right before listing all the risks.
I mean, when the fund's own lawyers tell you that something is critical for you to understand, that's probably a sign that you should sit up and pay very, very close attention. So let's just lay it out, side by side. Owning Robinhood stock, it's pretty straightforward. You own a tiny piece of the company. Simple. But owning this ETF, that's a whole different ballgame. Your exposure is indirect, coming from those derivatives. Your results get magnified by 1.2 times. And remember, that's both the good and the bad. And every single bit of your risk is tied up in the fate of just one single company. The prospectus lays out a whole bunch of what it calls principal risks. I mean, the big ones are pretty obvious, right? Non-diversification risk, you're putting all your eggs in one basket. Then there's derivatives risk, which is the chance those complex contracts just don't work the way they're supposed to. And of course, let's not forget, this fund is brand new, so there's absolutely no track record to look at. But of all the warnings, this one really stands out. It might be the starkest warning in the entire document. Because of that 1.2 times leverage, a huge drop in Robinhood stock has an even more devastating effect on the fund. They state that if Hood stock were to fall by 83.33% in a single week, the fund is designed to be wiped out to zero completely. It just goes to show you the extreme downside that comes baked into this kind of leverage structure. So at the end of the day, it's all about this trade-off, right? You've got this offer of enhanced exposure and income, but it's paired with some seriously concentrated risk. And that really leaves us with the big question, what does this kind of trade-off really mean for an investor?